The Federal Reserve pushed U.S. interest rates to record lows during the financial crisis, an effort to fuel economic growth by reducing the cost of borrowing. But on Wednesday, the policymaking body of the central bank eliminated the word patient from its official statement, something analysts say can only mean that rates are going to rise in 2015. Greg McBride, chief financial analyst at Bankrate.com, spoke with VOA on Skype.
And taking the word patient out of the statement basically gives the Fed the option, but not the obligation, to raise interest rates as soon as June if conditions warrant it.
Despite an improving labor market, Fed Chair Janet Yellen says we're not there yet.
Just because we remove the word patient from the statement doesn't mean we're going to be impatient.
The Fed says U.S. growth has moderated slightly since its last meeting in December. But Yellen says that's partly due to falling oil prices and a stronger U.S. dollar.
We noted that export growth has weakened. Probably the strong dollar is one reason for that. On the other hand, the strength of the dollar also in part reflects the strength of the U.S. economy.
Compared to other advanced economies, the U.S. is doing remarkably well. Chris Layden, a research analyst for the Manpower Group of Companies, says its latest surveys suggest a steady and growing demand for workers.
We have seen over the last really 6 or 7 years incremental growth in demand for goods and services, and that's really driving a stronger confidence that employers are having around hiring.
The Fed sees unemployment continuing to fall in 2015, perhaps as low as 5%, but inflation is expected to remain well below the Fed's target rate of 2%. Arcega, VOA News, Washington.